This is just a brief introduction to the cash flow indirect model. We start with our simple accounting equation here, equity plus liabilities equals assets, and I've just put in some numbers here to show how it pans out. For the cash flow indirect approach, we split our asset side into non-cash assets and cash. And that I've done here, so I've given just a number 11 for non-cash assets, and then cash is 2. We then take our non-cash assets to the other side in order to leave cash on the right-hand side. Now we have 10 for our equity, including profit, plus liabilities, minus 11 equals 2. And this is essentially the equation we work with, so it's a modified accounting equation. Here's an example from Rolls-Royce Annual Report 2017. As you can see, we start our cash flow statement with the operating profit. Now that is like saying that all our sales were for cash, all our charges, expenses were all completely cash payments. And of course, that's not true. Some of our sales are going to be debtors, some of our expenses will not have been actually paid. So we need to start with our operating profit and then make adjustments, taking out or adding back non-cash elements. Now, one of the main non-cash elements is depreciation. Depreciation is a debit to our profit and loss account, or income statement as it's called, and a credit to a provision account. So what we need to do is to reverse this, and we need to add back our deduction, to reverse our deduction, and that also on the liabilities side we do not include the increase in provision as a source of funds. And therefore we reverse our deduction because depreciation is not a cash flow. Similarly, our loss on sale there, that is not a cash flow. There may be cash flows involved in the loss on sale, but the actual loss itself is not a payment. So we've had this as a deduction from our profits, and we need to add it back in. Similarly, if we make a profit on sale, profit is not an actual payment. Therefore, it's increased our profits at the profit on sale. We therefore need to deduct it and reverse that entry. If we go back to the Rolls-Royce statement, you can see loss on disposal of property. It's been deducted from their profits, and they add it back in to reverse that effect. And here we have depreciation and impairment of property, plant and equipment. And here again you can see that it is added back in. Another main area of adjustment is to our working capital. Now, the working capital current assets appear in our non-cash assets, and current liabilities will appear in our liabilities. And you can see that in the accounting equation, we deduct our current assets and we add our current liabilities. In this example, an increase in debtors is an increase in our non-cash assets, and this is deducted. So an increase in debtors of 16 lowers the left-hand side by 16, and it's therefore, to balance it, we must treat it as a minus cash flow of 16, reversing our original assumption that all sales were for cash. We're saying no, these certain current assets ended up as debtors rather than cash. Now, if we have the decrease in debtors on this side, it's simply the opposite. So I have here minus a decrease in debtors of 15, and that is an increase. We can look at it in terms of, our debtors have paid over the period. We've had a reduction in our debtors, therefore in net terms we've received a payment from our customers. In accounting equation terms, it's minus 15. Minus a minus is a positive. You can put it on your calculator, just press minus twice and 15, and it'll give you an answer of positive 15. There's therefore this inverse relationship with relation to our non-cash assets, our current assets. An increase is deducted and a decrease is added. When we come to the current liabilities, the relationship is not an inverse, it's a direct relationship. So an increase in creditors is an increase in cash, and a decrease in creditors is a decrease in cash. Decrease in creditors is a simple one. We must have paid them, right? We don't owe them any more money. We owe them less money, therefore we must have paid them. And that implies that the opposite, an increase in creditors, is a source of funds. And it's a reversal of our original assumption that everything we paid for in cash. We didn't, and therefore we've got to add that element that we didn't pay for. We've got to add that back in to our cash flow statement. If we look at the Rolls-Royce statement again, you can see that an increase in inventories has been deducted. We have an decrease in trade receivables. It's a minus, so again an increase in trade receivables, this inverse relationship. But when it comes to payables, it's a positive relationship. A decrease is negative and an increase is positive. So here we have a decrease in payables as a negative and an increase in trade and other payables as a positive. We can therefore see this in action looking at the Rolls-Royce accounts. And these are the main adjustments that are made, but you need to practice some questions to go into the various details based on these fundamental principles. Okay, thank you.